Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining us for this segment, we have Brian Stutland, Chief Investment Officer at Equity Armor Investments, to discuss trends in the Nasdaq-100 Volatility Index and positioning with heightened geopolitics. Brian, it's great to see you as always. Welcome back to Trade Talks. And I just want to start with the performance that we're seeing in the Nasdaq-100 this afternoon, despite all of the headlines, since the weekend. Nasdaq-100's up over 1% on what was a very down morning.
Yeah, it is quite the reversal today. And, look, we were reaching some levels, both in the S&P 500 and the NASDAQ itself, where there was a huge amount of support, where levels that the market seemed intraday to be able to bounce off of literally for the last year. And now, all of a sudden, last night, as soon as we got the news about Ukraine and Russia situation, it broke those key support levels. The NASDAQ already was breaking some of that support earlier. And so that triggered a big sell-off in the market. But now we're seeing this trend all of a sudden reverse, as if there was too much pent-up demand to actually sell the market. And all those people shorting are getting flushed out and reversing back to the upside, back above some of these support levels that we saw earlier in the day.
Right, so it makes you wonder, okay, in the morning, we woke up in the middle of the night, I guess it was 3:30 a.m. on the East Coast, and we saw the immediate news. I believe with the president just making his speech, and we know that there's a coordinated effort. We know the EU, we know NATO we're doing this in a coordinated fashion. Perhaps that eliminates a little bit of uncertainty out of the market. It really is just such a stunning move from what the headlines looked like at 3 o'clock this morning, what they look like now, and I guess for market participants to kind of understand what the strategy is a bit more here.
Yeah, well, we heard Biden talking this afternoon, and basically what he said was they're going to allow them basically to and them to solve issues with Ukraine. If it goes further than that, they'll be ready to act with force. And so I think the market at least got some clarity where it's going to be, that Ukraine is going to be this neutral zone, fight over and let it hash out between the Russians and Ukrainians. And so that led some positive news. But the market had already been bottoming before that process. And I think the reason being, like I talked about, is we had this huge volatility spike overnight. I mean, I slept maybe 3 hours last night watching stuff for our strategies and our funds. And so as traders sort of just panicked in to sell as we broke those key support levels, I think that created somewhat of a flush out. And now the fact that we're back up in reverse actually could get all the shorts out of the market and short squeeze them to the upside. So I think that started the fire fueling back to the upside earlier this morning, late morning. And then Biden speaking about maybe we got some clarity, I think further has lifted the markets higher.
Yeah, for sure. And of course, let's mention from a humanitarian perspective, let's hope that, we'll put some water on the flames here. But it's interesting, yeah. Brian, in your notes to me earlier this morning, you had said regardless of geopolitics and looking ahead to interest rates, that you had expected a flush regardless. So my question to you is, let's say we weren't dealing with Russia-Ukraine headlines. It seemed as if the market a week and a half, 2 weeks ago, kind of understood. We know we're going to get rate hikes in March, whether it's 25 basis points, 50 bips, whether it's 5, 7, 8 times this year. We knew it was coming. We know it needs to happen. We know we need to tamper inflation. So to your point, it feels as if it was bottoming out even prior to the geopolitical headlines.
Yeah, well, I think when it comes to the Federal Reserve and we look at the interest rates market, one thing that I'm sort of noticing and coming to realization is that inflation is the problem. And the market likes it when you fix the problem. Whether it was 2008, there's a credit crisis. Let's fix that for liquidity and lower interest rates. 2020 pandemic, we need some liquidity in this market, lower interest rates. The problem now is inflation, which means we actually need a rate hike. And I think when the Fed comes out and actually hikes rates, I would love for them to actually even do a surprise 25 basis points before the meeting coming up. I think the market would love that, because I think that pops the bubble on this inflation commodity bubble we've been seeing. And I think the market will like that to the upside. So the problem right now is inflation. Let's see if the Fed can solve that. That will be the real determinant whether this rally we're seeing today can have some follow through and continue to the upside or not. Get that news out of the Fed Reserve as people start to turn their eyes towards that as we head to the March meeting coming up in the next month.
Right, because I mean, with oil and natural gas prices going in the direction that they are, I mean, that's the worst case scenario when it comes to tampering inflation. But Brian, if we take a look at the 10-year here and what's going on in fixed income markets, anything you can discern from there?
Yeah, well, I think it's actually really interesting, right? Because when you take a look at that, and Jill, when the interest rates are coming down lower on the 10-year, that is actually good for the big, large mega cap tech. The names that we typically see with the biggest market cap out there. Microsoft, Apple, Google, Amazon. Those companies do very well in a lower interest rate environment, and lower interest rate meaning borrowing money, years out, 5, 10 years out, right? Because now they can take that. We've talked about this before on the show. They can buy back stock. They can go out. They can acquire other companies. They actually like it when they see a market sell off because now the market's at a discount for them to acquire. I mean, they're almost like a private equity firm, right? As they sort of build up their growth by acquisition. So that when we saw the 10-year rate drop here, 5-6 basis points, I think traders kind of woke up and said, wait a minute, that's actually maybe pretty good for large cap tech. And that's where the Nasdaq has really been the leader in this rally today.
All right, Brian, appreciate the insight as always. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.